The core themes of this bull run are, according to me, digital, right? Any company which is a digital platform has exponential leverage. Those will continue to do well. Second, engineering, cap goods, cyclicals are at the core of this entire bull market. Third, capital markets.
Interesting.
Any companies which are at that inflection point of channelizing savings from traditional bank deposits to capital market savings are in a very, very sweet
Whether
spot.
it is product manufacturer or intermediary or whatever.
Absolutely.
Okay.
Fourth, real estate.
Nice.
Right? So these are some of the themes that we like.
Folks, welcome to PaisaVaisa. I'm yours Anupam Gupta, and on today's episode, I'm talking wealth management, market outlook, portfolio strategy, and much more with one of the oldest firms in the business. My guest, Ashish Shanker, MD and CEO, Motilal Oswal Wealth. Did I get that designate name right, Ashish?
Absolutely.
Welcome to PaisaVaisa, Ashish. Thank you. Finally, great to have you on the show. Thank you so much for doing this for our audience.
Super, Anupam. Pleasure to be here. And yes, finally we are doing this. Wish you and all your listeners a very, very happy Diwali.
Thank you so much, and wish you, loved ones, and everybody at Moti all the very best. What a business, huh? Wealth has been just booming for the last, I don't know, at least 2 or 3 years. एक साइड पे equity bull market चल रहा है, दूसरे साइड पे ये चल रहा है. Walk our audience through what is changing, what is happening, what are the drivers, how long will this continue? Because you have the Hurun reports out and you've got a lot of numbers floating around. Wealth managers have become the focus. So what are the key drivers here?
See, clearly, we've seen the evolution of this industry over the years. India has always been an attractive market to invest in. However, if you see the, first bull run, which is 2003 to 8, is the most vivid memory I have of a big bull run where a lot of sectors participated. Most of the liquidity was coming in from foreigners. And you've had a capital markets career. So if you recollect, whenever FIs would sell even $100 million, we would get scared, right? And all the conversations would be around what FIs are doing. If FIs put money, markets will go up. If FIs sell, markets will fall. Yeah. What has changed this time, Anupam, is the participation. Something switched in COVID. Of course, it was a confluence of factors. You had demonetization, so more digital currency. People, you had a lull in real estate. If you recollect, between 2012 to 20, real estate didn't do that well. Yeah. So people started seeking other avenues of investing, namely financial assets. And during COVID, everybody was sitting at home. They had a lot of time. And we became beneficiaries. When COVID hit and, we prepared to work from home, honestly, the first 1 month, we didn't know how things are going to pan out. But slowly what happened was people started opening Demat accounts. A lot of it was, I should give a lot of credit to that Jan Dhan Aadhaar Yojana.
Jam
right?
Trinity.
The Jam Trinity, because opening a Demat account and trading account became extremely simple. You could do it through digital KYC. So a lot of people started opening Demat accounts and putting money into their Demat accounts and buying stocks. Just to give you a perspective of how things have changed. Pre-COVID, there were 35 million Demat accounts in the country, right? Cut to today, you have 170 million Demat accounts. Massive surge in financialization. Yeah. And the good part is, whoever came into the market around that time, everybody made money. And that is resulted in a virtuous cycle. Sure. So, obviously, we've started seeing more participation in financial markets, and increased market caps means more wealth in the hands of the wealthy families, right? You had companies which maybe 3 years back were at a market cap of $500 million. Cut to today, some of them are trading at $4 to $6 billion market caps, right? So promoter wealth is multiplied 4 to 10 to 20 times in many cases, right? So a lot of the promoters are thinking, why not sell a small stake and create a family office or create a portfolio. So that's driving wealth management. Second, a lot of people who've been given ESOPs in companies, professionals,
or something,
startups, professionals, they've created a lot of wealth. And you've also seen a lot of money flowing from real assets to financial assets.
Okay.
Right? Because real estate also did well during this period. But typically what happens when you're stuck in an asset class for a long time where the price hasn't moved, the first phase of price movement normally results in unlocking. You say, okay, I bought a house at X value.
Book profits.
It's come to the same value. Let me get out, right?
Yeah.
And people saw stock markets doing well, and people started participating. They made money. So this virtuous cycle has resulted in financial participation going up exponentially. And obviously, that's a boon for wealth managers like us.
Yeah. You think it'll continue, obviously, at least for the foreseeable future, as long as the economy is doing well and markets are doing well.
It looks like it should continue.
So my next question is, our audience is a mix of a lot of people, hopefully more of retail. How is the investment decision for the family offices, for the wealthy, for HNIs, for ultra HNIs different from what it is for retail? Now, a retail guy, the last number I read was like an average SIP is about 2,300 rupees per month per account, right? Obviously, the HNI money is much larger than that. So what are the top 3 considerations that an HNI or an ultra HNI has when he's taking an investment decision?
Right. So I think you have to look at it, in 2 ways, right? The first thing is size of investment. So the moment you say that, your portfolio net worth is, let's say 10 lakhs, or let's say you take it to 1 crore, you take it to 5 crores, and then, ultra HNI is typically 25 crore plus. The type of instruments that you can invest in or the choices that are made available to you change, right? So if you have a portfolio of 1 crore, possibly you're restricted to mutual funds. At the most, you could go and buy direct stocks or direct bonds, right? Instruments like PMS or an AIF, are out of reach. Reason being, minimum for a PMS portfolio is 50 lakhs. And if you have a 1 crore total net worth, you're not going to go and put 50% of your wealth in one PMS, right? Similarly, for AIF, the minimum is 1 crore. So if you have a total portfolio of 1 crore, you're not going to be able to participate in an AIF as a product. The moment, your wealth becomes $1 million, and then you go further up to, let's say, $5 million plus, the range of choices expand, right? So today, what is very popular amongst ultra HNIs is investing in private companies.
Sure.
Right? These are companies which probably may go public in the next 12 to 24 to 36 months. And the valuations are probably more attractive than the listed peers. So there is some sort of an arbitrage. And
so taking a stake directly there.
Or taking a stake along with a fund. So we run a fairly large private equity practice, and we invest in several companies within our fund. Often, a lot of times, the total size required by the company in terms of fundraise is more than what our fund can allocate.
Correct.
So that extra amount then goes to our ultra HNI investors to co-participate with us.
So would this be a Cat 3
This
AIF?
Is a Cat 2 AIF.
Cat 2
Private
AIF,
equities normally get housed in Cat 2.
Cat 2. Public markets are Cat 3.
Public markets are Cat 3.
Hedge funds and all that.
Absolutely. And so when these Cat 2 funds like Motilal Oswal Private Equity invest in a certain companies, and if the size of the investment is large, some portion of that investment gets made available to our ultra HNI investors. So those kind of investments become possible when the size of portfolio is extremely large. Similarly, things like structured debt, right? So structured debt, these are high yield debt options where you can end up getting 15 to 18% return. Now, these typically happen through AIFs, or sometimes, again, even there you get co-invest opportunities. So the range of choices expand. And sometimes you get bragging rights. You get into a private company early, and if it does well, then
that's a big number you're looking at.
Yeah.
But tell me one thing: where is this on the risk return spectrum? I mean, if I were to look at risk return as an objective and as capital preservation as an objective. Right. Now, if I'm at 25 crores, if I lose a crore or two here and there, it's okay. Life will go on.
Yeah.
But what are the priorities there? Like, the higher the net worth, is it higher the risk or not?
So very interesting question. So if I look at, all our ultra HNI families that we service or those which I meet, higher the capital, actually the risk reduces in the portfolio. Generally, the attitude is, you've already taken risk and created wealth. So now that you have so much wealth, and for some of the families, the wealth is enough to last maybe in the next few generations.
Easily.
They tend to become more conservative, right? Typically the equity portion or the risky portion of the portfolio wavers between 30 to 40 or at max 50%. and about 60 to 70% of the portfolio goes into conservative asset classes. But
Okay.
within that conservative asset classes, what happens here, Anupam, is because of the size of portfolio, they are able to also get fixed income options which with a higher yield, which are more structured in nature. But today, given where equity markets are and the kind of buoyancy we are seeing, most ultra HNI portfolios are also skewed a little more towards equity. So if somebody, on an average, if they would be comfortable with 30% equity, probably they are edging now towards 50.
Yeah. PMS AIF. I mean, PMS I know is a pretty old product. It goes back to the 90s.
Absolutely.
The older guys, like ASK and all that, Bharat Bhai has been doing this for quite some time.
Yeah.
AIF is relatively newer in comparison. What's happening there in terms of flows? What themes are working? Because those are, those numbers don't come in the in the public domain as easily as the mutual funds and NAVs and performance. What's happening there?
So these alternative options are becoming very large and quite popular amongst the ultra HNI investors. If you look at the total size, I think the AIF size is about 3 lakh crores.
Wow.
Right? It was very small at some point. And this 3 lakh crores excludes some of the institutional AIFs I'm talking about.
So it could be larger, you're saying?
It's much larger. It's 10 lakh crores.
Wow.
But the ultra HNI piece is about 3 lakh crores. And PMS again is a similar sized or slightly. I mean, I'm taking out the EPFO money from PF. I'm only talking about
which you should also, only private money.
Yeah, it's about 3-4 lakh crores, right? So it's become a large asset class. Now, why do people flock to PMS and AIFs, right? Because mutual funds is the simplest product and it gives you a lot of tax benefits. See, the moment you can allocate a larger amount, you want to become a little more sophisticated in your investing. And in a PMS, it's actually a step up from direct equities, right? You want to see the stocks in your portfolio. You want a slightly more concentrated portfolio and you want somebody to manage it for you. So you can meet the fund manager, you can understand his or her style of investing. And once you're convinced with his or her style of investing, and then you give them capital. Minimum is 50 lakhs. So essentially what happens in the PMS is they take a power of attorney from you and they manage that portfolio on your behalf. And obviously the promise is that they will manage it according to the style that they are promising you. And B, they will create alpha over the regular mutual fund portfolio, or they will create more returns than what you can do on your own on the stocks.
For which they charge a performance fee or whatever. There is some structure there.
Absolutely.
Depending on which PMS you go for. Okay.
AIF is a slightly more evolved version of a PMS. The difference is AIF can again take concentrated bets. They can create a more riskier portfolio or a sophisticated portfolio as opposed to a mutual fund. But it has a wrapper and you get a unitized form of holding.
Like mutual funds.
Correct. So a lot of people who do not want the pass-through of a PMS, I mean, I'll give you an example. So let's say if I'm a consultant, I'm working in Deloitte, right? I'm forbidden from buying a lot of companies. Similarly, someone like me in Motilal Oswal, I mean, I meet a lot of... Due to compliance reasons, AIF is a far better wrapper. Second, AIF also allows you to take unlisted bets.
And short positions also, I guess.
Yes. So Cat 3 you can take unlisted up to 49%. Cat 2 entire thing can be unlisted and you can have structured debt and many other instruments. In Cat 3 you can also do a long short kind of a strategy. So it gives you more flexibility.
So when a guy comes, when an HNI or an ultra HNI comes to you asking that, tell me how to choose, tell me a good PMS, tell me a good AIF, what is the process that you guys follow? Like, how would you choose? Let's say there's someone who's watching this. Let's say he does have 50 lakhs to spare or whatever the number is, or a Cat 2 or Cat 3. What would be the typical process to choose a good one for them?
Right. See, the fundamental principles of portfolio constructions don't change. So, you first decide how many products you want. Let's assume, out of 100, you want to put 13 equities, right? Now, let's address the equity portion first.
Talking only about that.
If we address the equity portion, you'll first decide which products go into the equity portfolio. And it's never either or. I mean, this is the mistake all of us make, trying to pit one product against the other. It's never either or. So you say that, okay, let me do 50%, 60% of my portfolio in plain vanilla mutual funds, right? Plain vanilla, they're very powerful products, even though I say plain vanilla. And then you say that, okay, for 30-40% of my portfolio, I'll try to get a slightly higher return and create alpha. So there you can probably have a combination of PMS and AIF. Now, typically, the principles of selecting a PMS or a AIF are not very different from a mutual funds. I mean, we have something called a 4C process to select a fund manager.
Yeah.
So we first try and understand what is the style of the fund manager, the track record of the fund manager, and how consistently the fund manager has produced extra return over the benchmark, and obviously the capabilities that the fund manager has built, right? Once we are convinced on all of that, we are happy to onboard the particular fund manager onto our platform.
Okay.
So typically at any point in time, we will have 5 or 6 PMS managers on our platform. We will have 7 or 8 AIF products on the platform. So the fund manager selection process is the same, and depending on the risk appetite of the investor, we would say, okay, hey, these 2 fund managers probably fit in to your philosophy and your the outcomes that you desire. In AIF, you can become a little more product centric.
Sure.
So for example, there is a product that we are currently running, which has 60-70% listed companies and 30-40% unlisted companies.
Okay.
For somebody who doesn't have the size to buy into a private equity fund, this is a good alternative. It's a hybrid alternative,
right,
where you're getting 30-40 unlisted, 30-40% of the portfolio unlisted, and
yeah.
60-70% listed.
Yeah.
Similarly, if you want to have a better risk-adjusted outcome, then you go to a long-short kind of a strategy.
I like to look upon you as this, multiplex operator, where you are getting the movies on one side and the audience on one side.
Absolutely.
So kya chal raha hai, kya theme chal raha hai, right? So Bollywood has had a tough year this year, but irrespective of that, PMS AIF mein kya theme chal raha hai?
So last 3 years have been fantastic. Clearly the broader market has done very well. So fund managers who have a more value orientation, or to put it very simply, people who have taken bets in cyclical companies, right? Because a lot of these sectors didn't participate in the earlier decade.
Yeah.
Now suddenly you see a wider set of sectors participating. The fund managers which are more oriented to those sectors have done extremely well, right? Whereas people who probably are more quality oriented have not done as well, because those companies, it's been a rough time. So the companies were probably richly valued, and you're seeing a derating going on there, right? So those fund managers have done extremely well. The contrarian fund managers have done extremely well. And whether you like it or no, money still chases returns, right? Obviously we can wax eloquent about style of the manager, etc. Bottom line is performance. So people look at last 3-year ticker, 5-year ticker.
It's like a Bollywood star, right? Movies perform kiya, so then you're at the top of your game, man.
Correct. So those kind of fund managers are doing extremely well. Private companies, you're seeing a lot of trades happening. Obviously the mother trade is NSC.
Yeah.
Right? Everybody seems to have that in
their
portfolios.
Has the IPO gotten a go-ahead or no?
I think there is a lot of work going on, and the way
but
they are
still not got approval.
Clearing all the issues looks imminent. The IPO looks imminent.
It's the most traded block out there in private unlisted companies. I think the block is also fairly large. Like minimum value itself is about what, 2 crores or something? Yeah.
So the post bonus price.
Yeah.
It's speculated to be around 1,500-1,600 rupees,
okay.
right? And it's 1:5, so 7,500. It's in COVID. It started at $800.
Wow. So 800
so it's almost
and
10x.
A bonus and 10x.
Almost 10x. Almost.
But
10x.
You need to have a certain number of shares blocked for you to buy that. You can't just buy 1 share or 2 shares.
Correct.
Well, let's see when that is.
Correct.
What's happening with the traditional avenues of HNI investments like real estate, gold, or physical assets and all? Is there still demand out there?
So I'm glad you asked that question. I think real estate has seen a resurgence. So what we are
especially since you have a real estate fund also.
Yes, fund, and we also have a real estate broking division.
Okay.
So we are suddenly seeing a huge appetite from ultra HNIs to buy luxury properties. Huge appetite.
Interesting.
Because look, how much ever wealth you create, right? The wealth in your demat cannot be seen, right?
You call your friends over, you can say, "Here, mera demat account hai."
Absolutely.
Call your friends to your house.
Absolutely.
You can.
So suddenly you're seeing in Bombay, houses being sold for 50 crores, 100 crores. And you're seeing this happening in Gurgaon now, right?
I thought Delhi Gurgaon was the original places for these huge properties. They have a lot of space. Bombay was slightly...
No, but the ticket sizes in Bombay much higher because the land prices are crazy in Bombay. But suddenly in Gurgaon, you're seeing, builders launching projects at 50 crore, 80 crores, 100 crores.
And getting lapped up.
So real estate is back. I think people are buying properties for their own use, and obviously they want to buy trophy properties because, as I said, a lot of promoter wealth has been created in this bull run. So clearly you're seeing that trend. Even amongst middle income households, property, the volumes are extremely encouraging.
Yeah.
And most builders, from being debt strapped 4-5 years back, have become cash positive now. Balance sheets have got cleaned up and the volumes have suddenly exploded. Also, what has happened parallelly is because of RERA and GST and a lot of regulations, the industries got consolidated.
Yeah. And cleaned up. Yeah.
And cleaned up. So in every city, the people who are actually now building homes are the stronger hands.
Yeah.
So clearly real estate is back.
So I heard one of your interviews, and I also get your monthly newsletters. And I really like the fact that you have such a big focus on asset allocation. I like the fact that in your strategist monthly reports that come, it always starts with correlation of various asset classes. You have a correlation of India equity, US equity, gold, debt, and a lot of other stuff. Okay, so why is this focus of asset allocation so important when equity in India itself has become it's like fixed deposit? People are taking it for granted. 1% per month तो ऐसा ही बन जाता है, 12% per year तो ऐसा ही बन जाता है, small cap, mid cap में तो 30-40% बन जाता है. And here is Ashish Shanker talking about asset allocation.
Yeah, so look, you also have a capital market background and you've seen cycles, right? Markets, life, both are very, very cyclical in nature. So I think asset allocation is like a balanced thali, right? You have more of desserts or you have more of mains, your stomach is going to get upset at some point in time, right? So if you don't want to have an upset portfolio, you need to have a balance. So asset allocation actually solves for 95% of the problems in investing, because 95% of asset allocation determines 95% is determined by asset allocation. The outcomes, the portfolio outcomes are determined by that.
Not security selection.
Not security selection, right? So it's extremely important. But what happens in a market like this, right? People get carried away. Because making money becomes so easy. I mean, it's like a dartboard, right? You just throw darts at any company out there and you suddenly see after a year, your portfolio is up 40-50% and you tend to get carried away. So it is extremely important at this point in time, at this juncture, for us to keep reminding clients not to forget their core risk appetite and asset allocation. So I always keep telling clients, your risk appetite is how you felt when markets fell 40% during COVID.
March 2020.
Right? Your risk appetite is not what you're feeling today, right? What you're feeling at the worst is actually your risk appetite. Now, for a lot of people whom we've worked with over the years, right? I've been working with clients now for 10 years, 15 years, 20 years. I imminently know their risk appetite. So a lot of times when they get excited, right? And they say that, Ashish, let's put more money in equities. I tell them, look, calm down. Let's stick to where you are right now. And we'll see. Let's see the next 1 year. And markets are cyclical, and who knows, even in the biggest bull market that I have witnessed in my career, 2003 to 8, markets fell about 30% in 2006, right? So that could happen even in this bull market.
Which is in a longer bull market, you have a sharp fall in the middle somewhere.
You could have that. So I think it's extremely important not to forget your risk appetite, and asset allocation solves for that, and it smoothens the ride. So I'm a big believer that you should have equities, you should have fixed income, and you should have gold as well, because gold acts as an insurance. I always say that it's the protector of capital in dire times.
In whichever format you choose. Could be an ETF, could be whatever.
Absolutely.
You have an ideal thing right now. I mean, an ideal asset allocation. I know that the requirement for every investor is different.
Right.
So that's a caveat to the audience as listening to this. It also depends on your risk return profile and your objectives. But in general, like one of the most popular asset allocations was simply 60-40. 60 equity, 40 debt.
Absolutely.
Or 100 man-years age. Do you think that's still a good thumb rule to go with?
Yeah, so two thoughts there, Anupam. I mean, I keep it normally very simple. I always say that there are three asset allocation models. Right? One is 25-75, conservative. 25-30 equities and 75 debt and possibly 5% in gold.
Okay.
Right? The balanced portfolio, where you have 15 equities, possibly 40 in debt and 10 in gold. Right? And the aggressive portfolio, where you have 75 in equity, but then you have more in gold. You have 15 in gold and 10 in debt.
Okay.
Right? These are the classical portfolios. And the best time period to readjust your asset allocation is once every year. And we've done a study for 30 years. It works beautifully. I just want to add one more strategy. which we have backtested for 30 years.
Nice.
And we call it the all-weather strategy. And it works beautifully. Okay. It's the 5 asset strategy. The 5 assets in that are cash. Okay. Cash is an allocation. Debt. Then you have Indian equities, US equities, and gold.
Wow.
All in equal proportion.
And all not correlated to each other.
Absolutely.
Yeah.
All in equal proportion, balanced once a year. This portfolio never loses capital on a 3-year rolling basis.
3-year rolling return is always positive.
Yes, and the average outcomes are between 9 to 11%.
Oh, not bad, eh?
So for someone who's moderate in risk profile, if they follow this asset allocation, I can tell you will never be disappointed.
Wow.
And we run this on one of our platforms.
And reasonable volatility, not big drawdowns, because I saw the numbers on your in your PDF. I mean, the drawdowns on debt, hardly. The drawdowns on US equity is actually much better than the drawdowns that we have out here in India.
Correct.
And gold mein to drawdown pata nahi.
So I'll tell you something which is very contrary to people's belief system. Indian equities and US equities have the lowest correlation.
Okay.
It's 0.3.
Is that right?
Yes. So when US equities does extremely well, Indian equities doesn't do that well.
Okay.
And vice versa.
Right.
So anybody who asks me, should I do global diversification? The answer is yes for again, HNIs and ultra HNIs who have large capital. But when they ask me which geography should I invest in, I mean, I tell them US is the only place you should be investing in. Because it gives you best in terms of diversification and correlation.
And it's largest and most liquid, na?
Absolutely.
Why do you want to be in some random country with some random this when the time comes to exit? The doors are closed. US never has that.
Correct. Let me also address your other question because that's a very interesting question. Should it be 100 minus your age equities? Now the classical studies say yes, but I have a very contrarian philosophy there. See, for people who have created wealth above a certain number, actually, debt should be a finite allocation, not a percentage.
Oh, in absolute numbers.
Yes, because your wealth is going to outlive you. So you can actually potentially take far more risk than you believe. Because a large part of the wealth is actually going to go to the next generation.
So you should, that's a longer timeline.
Absolutely.
And if you have a longer timeline, you should increase the risk.
The moment you go above a certain number in your portfolio, right? When your basic needs are met, and you like I said, a lot of ultra HNIs have created wealth for the next 1 or 2 generations. Then you should start thinking of debt in terms of finite number other than allocation.
So an absolute corpus where the capital is preserved and you just live off the returns and you're kind of sorted with that.
Yes.
Chalo, theek hai. Enough. Now our favorite kya lagta hai sawal, like outlook on stock markets. I can't think of a longer period year on year where you've got positive returns. This 8% correction that we've had in October reminds me of exactly last year October. Because last year October when the market fell 8%, it was up 40% the next year.
Correct.
And here we are sitting now on a similar 8% on the Nifty.
Correct.
Obviously sharper on the small and middies, which is fine. Where do you go from here? With, I think 20,000 crores. Is it the SIV number?
Yes. It's more. It's bigger. It's getting bigger every month.
So 3 bill per
around
month.
25,000 I think.
So that's about 3 bill per month multiplied by 12. So 40, 50 billion coming in from there.
Correct.
What do you think here?
So, Samvat to Samvat, right? We're entering the new Samvat. Nifty is up 24%. Mid cap, small caps are up more than 30%. Portfolios are up 40% plus. So, it's been a great year. And come to think of it, last year, same time, planes were flying over Taiwan. We were worried about a third world war, right? So, we should be very happy with the outcome, first of all, regardless of the 7-8% correction, right? So I have a framework, Anupam, on bull markets, right? If you look at history, right, typically bull markets last anywhere between 5 to 8, 9 years, right? And markets tend to expand anywhere from 5 to 8, 9 times. Okay, and US has a longer history, India has a relatively shorter history. Now, if I look at the last big bull market, and I keep visiting that, and probably the mother of all bull markets happened in the 90s, but it happened in a very shorter time frame, right? Harshad Mehta.
And it was not exactly believable, so to say. But
Correct. So, I believe that this bull market has the makings of both these bull markets combined, because 92 a lot of domestic liquidity came in, right? How it came in is a different issue. In 2003 to 8, a lot of foreign liquidity came in. But it was also driven by fundamentals, right? Earnings growth was phenomenal.
Economy was doing well.
Economy was doing extremely well. This time around, if you see, the stock market price growth has been backed up by fundamentals.
Correct.
The other statistic I'll give you, Anupam, this will be, I think, the 5th financial year where you'll have double-digit EPS growth for the index.
Oh.
It's never happened in the history of stock markets.
Lost track of the EPS number completely. Okay.
It's never happened, including 2003 to 8. Okay. So there is a very strong fundamental backbone to this rally.
Sure.
A. Second, a lot of sectors are participating. And I don't believe that bull markets mature in these kind of circumstances. Right? So I still feel we have a long way to go. Right? So in very simple terms, I say अगर बॉम्बे से पुणे जाना है तो हम लोग लोनावला पहुंचे हैं.
Nice.
अभी और टाइम है. Okay. In between this, yes, the difference between your travel and bull markets is you can come back from Lonavala to Karjat and then resume your journey from Karjat to Pune.
Yeah.
Right? So people who are invested should stay invested. There is still a long way to go. In terms of sectors and themes, the other question that you asked, generally the sectors and themes in a bull markets don't change. Right? They rotate. So, for example, PSUs, defensives, cyclicals defense and cyclicals have done extremely well. So much so that valuations have got massively overextended in defense. They've corrected 20-30%.
Sure.
PSUs have also corrected.
Sure.
So that happens. So maybe they take a breather. But the core themes of this bull run are, according to me, digital. Right? Any company which is a digital platform has exponential leverage. Those will continue to do well. Second, engineering, cap goods, cyclicals are at the core of this entire bull market. Third, capital markets.
Interesting.
Any companies which are at that inflection point of channelizing savings from traditional bank deposits to capital market savings are in a very, very sweet spot.
Whether it is product manufacturer or intermediary or whatever.
Absolutely.
Okay.
Fourth, real estate.
Nice.
Right? So these are some of the themes that we like. Yes, intermittently what happens is, pharma as a theme didn't work for 3-4 years. Now it's bouncing back. IT is like a contrarian theme right now.
The biggest one, private banks.
Cheap. I think banks will underperform. Private banks will underperform. So I'm a big believer of this rally being led by non-banking players.
Very interesting.
Intermediates.
So private banks haven't gone anywhere, by the way, for the last 2-3 years.
They'll struggle because they have a lot of challenges.
Even with the falling interest rate regime coming in the next 1 year.
Yeah, NIMs are under pressure and credit growth is slowing down. See, think about it. If you're getting equity at 2% yield, why are you going to go and borrow from the bank? You see the number of QIPs which are getting launched.
Yeah.
Right? If your PE is 50.
Yeah, but I'm just wondering, then how does that equation play out? You can't have banks sitting out of an economy expansion. Like, somewhere or the other, something should work. I don't know.
I think maybe in the later stages of the bull market, they will participate.
Yeah.
But even lending, if you see, NBFCs are growing faster than banks. I think somewhere RBI is also, trying to keep checks on banks. So they have come down very heavily on banks on the unsecured portion of their balance sheet. RBI is willingly, I think, keeping money tight. Right? So the NIMs are getting compressed as we speak. There is a fight for deposits. So banks will participate. All I'm trying to say is that the leaders of this bull market may not be private banks.
Okay. I want to get in some caution here, or maybe some, let's say, a theoretical thing that when you're talking to your clients, what would be the 2 or 3 things that you would look out for to know that maybe now there's a problem? Okay, because right now, though, of course, everybody is chasing returns, having a good time, even though the markets have fallen, whatever has happened. There are some indications of some slowdown in consumers that has come in the headlines, the unsecured lending that you're talking about now. Most of it is, of course, because the RBI itself has put the brakes, but who knows? There might be a deeper problem, pata nahi. That time will tell. But from your clients, like if you were to notice some behavioral changes, that would make you wonder, ki bhai, now we need to probably be a little bit more cautious. What would be the 2 or 3 things that you would look out for?
See, typically, I like the Howard Marks framework. He talks about cycles, and I think he's the best guy to read on cycles. Right? So he has a checklist of a bubble. So 2-3 indicators. One is when everybody and anybody on the street is investing in stock markets and generally bullish, right? So if you speak to and if you tell clients that don't invest in equities and they still end up investing in equities, you go to a cocktail party and you're from capital markets, but you're not the person giving advice. Everybody else is giving you advice.
Okay.
These are some of the soft indicators that, you're probably in a mature bull market. No, I think people are still apprehensive. Okay. People are still worried about valuations.
Okay.
And I think people still listen to me. At least few people listen to me in cocktail parties.
Okay.
So, theek hai. I mean... it's not reached that extreme.
They're not telling you, Ashish, buy this stock as yet. Okay.
Some people are telling me, but not all of them.
Okay.
Right? There will come a time when everybody will tell me you don't know anything and we will tell you what
then
to buy.
You know.
So tab time aa gaya samjho.
ठीक है.
Second, when credit growth is on a tear, right? When your credit growth is 25-30%, people are leveraging without, and they're leaving caution to the wind. Bank credit growth is 13-14%. Balance sheets are pristine. Corporates are not borrowing big time. Corporate balance sheets are pristine. So these are not late stages of bull market, right? Typically, and then on the valuation side, you start valuing holding companies on sum of parts, and we heard eyeballs during the.
This time around they had a special trading session. वो holdcos कुछ हुआ ही नहीं उसमें.
Correct.
I think that just fizzled out.
Yeah, absolutely. So I mean, some of the narratives go crazy, right? I mean, अपना 2000 bull run, you had eyeballs, right?
Who can forget that?
Correct. And 2007-8 में land banks, right? Even Infosys land bank started getting valued. I remember, right? Infosys has so much land around Mysore and all that. So वो time अभी आया नहीं है. It'll happen, definitely happen. And typically bull markets don't peak on reasonable valuations, right? 2021 में people 2021
which
times
is where we are right now.
Multiples. I mean, peak of the bull market in 2000 was what, 28 to 30. I think
and some
was 60. I hear. I mean,
some sectors would have gone somewhere else only.
Correct. So some sectors are exhibiting exuberance right now, but largely market as a whole, ठीक है, मतलब mid cap seem a little expensive, but you still find opportunities and stocks which are growing.
Sure.
So I think when that happens, you should start being careful. But again, Anupam, in my experience, timing that is very difficult, right?
Which is why I want to wrap this up with your advice to someone who's a 25-year-old starting his career, wants to invest in the market for the very first time. Right. What would your advice to him be?
It's a very boring advice, but I think SIP is probably the best way to accumulate equity assets through mutual funds.
So now I've got the method, which is SIP. What would be my instruments out there?
I think mutual funds is the first instrument I would buy into.
Go for a simple index fund.
Go for a flexi cap fund or an index fund. Right, there are flexi cap funds. The popular ones are doing, Parag Parikhs of the world, HDFC, ICICI, Motilal. I mean, you have 7-8 good houses. Pick up the flexi cap fund. Don't go to the thematics.
Since you're young and you can take more risk.
Correct. Similarly, now you have indices across the board, right? So if you're young and if you have a long period of investing, go for the risky index. Go for the mid cap index. Go for the small cap index and do the SIP, because volatility works in your favor in an SIP, right? And then, if you still want to, make your life interesting, I think try and invest in the sector that you understand. So if you're an IT professional, right, try and buy IT stocks, right? Typically, I have seen clients, when I meet clients in a particular sector, they turn out to be more intelligent than us. So if you meet a promoter in the consumer sector, they have a feel for the sector. Like I have friends in the auto sector, right? They know when there is a slowdown coming or when there is a turnaround coming. So maybe if you apply your thought in the sector that you're working in, you have a better chance at succeeding. So maybe a small portion of the portfolio, because otherwise, look, nobody's going to listen to us if we tell them simple SIP karo. I mean, you need some excitement also in your portfolio, right?
It reminds me of the ad that you guys run, the Motilal Oswal man. Research. Ramdev ji himself comes in that ad.
Correct.
And if you can do that research in your life for mutual funds, then you should do that.
Absolutely.
Fantastic. Folks, there's your strategy. And our last question before we let our guests go is, what book are you reading or anything that you're watching or any content recommendation? I know that you're a very, very busy man and you don't have time for all this, but still.
No, I'm an avid reader, Anupam, but unfortunately last few months I've not got too much time. But it's interesting you asked me this question. There's one book which I've revisited. It has nothing to do with finance.
Okay.
I revisited the book Fountainhead
by
Ayn Rand, which I think I would have read 15-20 years back.
College.
Yeah,
that's when you usually
college,
read it.
In college. And I found it very interesting because, your framework or your references are very different. at different stages in life.
That's the story for capitalism.
Yes.
It's like the Bible for that.
Yes. Fountainhead is more, I thought, around excellence, right?
Okay,
do you pursue excellence or do you pursue mediocrity? I mean, the Peter Keating versus Howard Rock example. Atlas Shrugged is, of course, the ultimate book on capitalism.
Okay. I mixed my ends out
So
there,
Fountainhead, I found it very interesting, reading it after 20 years. So a little different book.
But it's always useful, It's a classic.
And then, of course, Morgan Housel is a classic. I mean, I loved reading both his books, Psychology as well as Same as Ever.
Same as Ever and Psychology of Money.
Absolutely.
Time to write your own book, perhaps. You should do that. But with that is a wrap on this episode of Paisa. My guest, Ashish Shanker, MD and CEO, Motilal Oswal Wealth. Ashish, all the best. May the wealth increase. It's Diwali and, best wishes for a happy, prosperous new Samvat. Let the bull market increase and have a great time. Thank you so much for doing this for our listeners.
Thanks, Anupam. Pleasure to be here and hope to do this more often.
Please
Let's
come
not
back.
wait for so many years.
I don't
again.
understand. 7.5 years we've done of this podcast. We've never had him. First time he's coming up, and I'm really like, chalo, ho gaya, chalo.
Right.
On the occasion of Diwali, I don't think it can get any better than this. Keep coming back to our show.
Pleasure. And happy Diwali.
Thanks a lot, Ashish.